We're going to start with the main themes that anybody that is in the hospitality space know about, and anybody that is not, I think, should know about. So we think at JLL that transactions volume globally will rise to 80 billion from the 60 billion where we are right now. 60 billion is very close to where it was last year, but significantly below where it was in 2015, which again, we'll see a graph related to Europe and go about it. A lot of investors, mainly institutions, and this everybody knows about it, have gone up the risk spectrum or has gotten comfortable with hotels. And we love it because it opened a whole new pool of investors for us, where you have a shortage of one country, you have a surplus of another, and they've been extremely active in our market. The reality is, why will transactions volume increase? Because of this new allocation of institutional, because people are looking outside of the traditional markets. Many of you were here in 2010, and we were only talking about Paris and London. In 11, Paris, London, a bit of Amsterdam, 12, Paris, London, Madrid, Barcelona, Amsterdam, German, and so on. And now the CEE is also back on the map. Spanish resorts are back on the map, and we were talking about Greece earlier. Greece is back on the map. We think that there's going to be a lot of consolidation. So the big brands have started the consolidation, and this is a good thing because they can share their systems and so on. But it also created some smaller brands that I personally like a lot, because you get in the hotel and there's something real about it, which are popping up and which are increasingly coming to the market. So that created that space for them, and eventually they'll be gobbled by a big brand and so on, or not. We think that tourism arrival will increase. This is a common theme amongst everybody. It doesn't really come from us. And we think that specialist investors, hotel investors, will more and more, there will be less of them, but they might also more and more position themselves as operating partners to support the lower cost of capital investors who are the institutions, who still would like to have somebody that knows how to run hotel inside out. So in terms of volumes, for Europe specifically, as you can see, 2015 was a peak, and there are two theses that are really going on. The first one is saying, we had a peak, we had a mini crisis, and now is the new norm until the next peak. And another one that said, we didn't really have a peak because transactions volume are still significantly higher than they were 10 years ago, and back to 2007 levels. So where is it gonna go? Now the important bit here is that Europe, the European share is about 23 billion, and we think in 17 the European share will also be about 23 billion. Mainly made with the three most active markets will remain the UK with 4.5 billion, Germany with 3.5 billion, and Spain, that is like a big thesis here, with about 2.5 billion. And all of these numbers are in euros. Interestingly, the sources of investment, every agent you talk to will say Asian investors is great, and Middle Eastern investors is great, and European, US, but the reality is there's no Asian investor. You have Singaporean investor, you have Thai investor, you have Hong Kong investor, and you have mainland Chinese investor, and all of them behave in a very different and particular way. So although for Asia, for example, we do put them in one go, the reality is they're all very different. And it's the same for the Middle East. The Middle East is UAE investors, is Qatar investor, and it's KSA investors, and none of them, OIF as well, so Oman investor, but none of them behave the same way. So it's a big shortcut to just say Middle Eastern investors has increased. The reality is, who has increased in the Middle East? Is it Qatari high nets, or is it the Saudis that are now looking at acquiring leases, obviously no alcohol, and getting into our space? So graphs are interesting, but the reality is the big themes here is European investors are still in the market. They're mostly made of institutions. and those institutions are going to continue growing. So for anybody that has an exit, I think this is a good plan. And for anybody that is an institution, I think you will find more stock in the market. And this is where we boil it down to what I just said, which is, what is the denominator of those investors? Is it a Singaporean REIT, or is it a Qatari high net worth individual? And most interestingly, the two biggest investors today are private equity into Europe, are private equities, mainly from the US, but not only, and institutional investors. If you aggregate institutional investors with REITs, they made up 28% of the total volume. And REITs, we also saw that there are Singaporean REITs, the likes of CDL, the likes of MNL. In terms of transactions volumes, this is mostly single assets portfolios, but not cross-border portfolios. You can see that we are almost everywhere beating where we were in 2007 on a much, much, much better fundamental, because the leverage is much lower, the capital is there, and the cost of capital is where people are playing, as opposed to maximizing the leverage and taking too much risk. And as you can see, Paris and London are still the two top cities, but the reality is Madrid, Barcelona, if there was more stock, would have been high up in the agenda. Amsterdam, if there was more stock for sale, would have been high up on the agenda. It's the same theme for RevPARs. So given the number of travelers have increased, the supply, we're going to see that later, hasn't increased massively, and the number of hotels is fixed. You can see that people can now play on the RevPAR and start pushing it up, both in terms of occupancy and in terms of ADR. And this is also comparing it to 2007, because everybody refers as it as the previous peak. But for Paris, you could compare it to 14, and you can see that the peak in Paris was not 7, was 14. So again, right, graphs are great, but what's behind the graph is usually even better. And then to finish, the supply in Europe has been fairly stable. These numbers could be a bit misleading because the 22% in Warsaw will not crystallize. It's probably going to be more of a 10 or a 12%. Munich is the same. Munich center will not change. It's everything that is in the fringes that could see some supply. And Amsterdam is the same. Amsterdam, if you're within the, how do you call it? The
ring.
The ring. If you're within the ring, that's where you want to be. Then there's no supply, and if you're outside of the ring, then there's some conversions and so on. But overall, stable supply, increasing RevPAR and ADR, and transactions volume that are, again, very stable compared to last year and the year before, in our view, is a perfect recipe to bring investors into Europe. One thing we're not mentioning here is that all our investors compare Europe, the US, and Asia, and they all see the most value in Europe because interest rates in the US are going up, and they think, and debt is much more expensive. So on a cash-on-cash basis, you're better off with a lower yield in Europe, but a better cash-on-cash, so a better capital structure. And lastly, cities in Europe, I mean, if you look at Rome, if you look at Munich, if you look at Amsterdam, if you look at London, if you look at Paris, they've been there for longer than any of us can remember, but longer than any of us have probably read of. And this thing is not going to change. So Paris is not going to become suddenly Cergy or Roissy or whatever. It's going to stay Paris. And this, from a flight to safety, is also very important, because people want to know that the capital city is not going to change and their investment is not going to be irrelevant because the center moved.